Hello and welcome to this session in which we are going to be working in chapter 14, and specifically we're discussing the cost of capital. Now in this chapter we learn about the cost of the debt, the cost of the preferred stock, and we also learn about the cost of equity, which is the cost of common stock. So in this session, basically we're going to take everything that we learn and we're going to look at the weighted average cost of capital. Now, the weighted average, the cost of capital. Let's review real quick. Just basically, we want to make sure we understand where we finance our company. If we look at the simple accounting equation, assets equal to liabilities plus equity. So basically, we can say all your assets are coming from debt and equity. Now, debt we have long-term debt and we have short-term debt. And in equity, we have retained earning and we have common stock. This is what composes of equity. But the idea is all your assets are coming either from debt, liabilities is debt, or from equity. Now, this is the accounting equation. This is the accounting equation. But based on this accounting equation, we can infer the capital structure of a company. What is the capital structure? The capital structure is basically where are you financing your company from? And the two main components of how you finance your company is debt and common stock. Now, under debt, we have long-term and short-term. Because short-term, we don't use short-term, company usually heavily use long-term debt, so we're going to be looking at the long-term debt. And for equity, we're not going to use retained earning. Retained earning is an internal financing mechanism. We're going to look at common stock, and also we have, just to make sure, we have common stock and we have a preferred stock as well. So we could have common stock and preferred stock. So we can say the value of a company, the value, basically the capital structure, equal to equity, which is equity represented by common stock and preferred stock, plus debt, equity plus debt. Now, just to kind of work a quick example, if we say we have equity worth of 100, let's see, equity equal to 60, and debt equal to 40, that's going to give us a total value of 100. Total value of 100. What we can say that 60%, 60 divided by 100, equal to 60% of the company is financed by equity. This is the capital structure, and obviously 40 divided by 100 equal to 40%, that's coming from that. So we can say the capital structure of this company, 60% equity, and 40% debt. Now, the question is, how did we come up with the equity? How did we come up with the equity? Because if it's not, because equity, what equity means retained earnings plus common stock plus preferred stock. What we mean by equity here under this equation, what we do is we take the number of shares to find equity, to find the equity, which is called the market capitalization. How much is the market capitalization of the company? What we do is we take the number of shares outstanding, and we multiply them by the price of the share. To find the debt which is the debt of the company, what we use is we use the number of bonds. Basically the number of bonds. So we'll multiply it by the market price. Number of bonds outstanding times the price. And what we mean here, the market price. So this is how we find the debt. This is how we find the equity of the company. And once we find the debt and the equity, we can find the total value. I just gave you an example. But this is basically how we find what we call the capital structure. So we want to know how much is our assets are financed through equity and how much of our assets are financed through debt. But since debt has long-term and short-term, when we look at capital structure, they ignore the short-term. The short-term debt is basically ignored. Why? Because the short-term debt has a book value the same as the market value, because short-term debt in nature, it's short-term. So in the short term, the market should not change a lot for a loan. That's why we ignore the short-term debt. Okay, so let's go back to the book and start to basically start to practice what we did. But this is the basic idea of the capital structure of a company. So we will use E for equity to stand for the market value of the firm's equity. We calculate this by taking the number of shares outstanding multiplied by the price per share. Excellent. We use D for debt. So we use a different color. We use D for debt to stand for the market value of the firm's debt. For long-term debt, we calculate this by multiplying the market price of a single bond times the number of bonds outstanding. Okay, so we have two components, E and D. E is equity and D for debt. If there are multiple bonds, as there are normally would be, the company would issue multiple bonds, not one type of bonds. We repeat this calculation of D for each, then add them up. If there is a debt that's not publicly traded, because again, not all debt is publicly traded, we must observe the yield on similar publicly traded debt, then estimate the market value of the privately held debt using this yield as a discount rate. So if the debt is not publicly traded, we don't know what is the yield, how much it's costing the company, but we could look at similar publicly traded debt to estimate the cost of that debt. And remember what I said, for short-term debt, the book value and the market value should be the same. We might use the book value as estimate for the market value. So there's no need to estimate the market value of short-term debt. So basically what we can say, the value of the company equal to its combined equity and combined debt. Okay, if we divide both sides by V, so if we basically want to divide both sides by V, we can calculate the percentage of the total capital represented by debt and by equity. So if we divide both sides by V, what's left on this side is the number 1, or 100%, equal to E divided by F plus D divided by V. So basically what I just showed you, as I said, 60 divided by 100, and this 100 is not the same as 100%. I just happened to, I should have chose something other than 100. So let me look at another figure. Let's assume the total value equal to 150. Let's want to use something other than 100. 90 plus 60. So 90 is equity and 60 is debt. Well, we can say the equity is 90 divided by 150. So if we look at 90 divided by 150, that's going to give us 60%. Again, and 60 divided by 150 equal to 40%. I also end up happening with 60 and 40, but again, this is a coincidence. Okay, these percentages can be interpreted just like the portfolio weight, as they are often called the capital structure weight. Okay, let's look at an example. If, for example, if the market value of the company stocks were calculated as 200 million, so equity in this example, equity value equal to 200 million, and the total market value of the company debt is 50, so debt equal to 50 million. Okay, so what is the capital structure of this company? Well, the total value of the company equal to 200 plus 50, which is equal to total value equal to 250. So equity equal to 200 divided by 250, and debt equal to 50 divided by 250. So that's going to give us 80% equity and 20% debt. They have to equal to 100%, obviously. Okay, so this is how we calculate the capital structure of a company. Okay, we emphasize here that the correct way to proceed is to use the market value of the debt and equity. Because if we use the book value, it's the book value. Basically, it's based on historical data. So what we say is the best way to calculate the value of the capital structure is to use the market value. Under certain circumstances, such when calculating the figures for a privately owned company. And what happened to privately owned company? They don't have public figures. They don't have a public stock. So we don't know what the price of the stock is. So it may not be possible to get a reliable estimate of these quantities. In this case, we may go ahead and use the accounting values for debt and equity. Although this would be probably better than nothing, we would have to take the answer with a grain of salt. Of course, if it's a publicly traded companies, we can use the accounting numbers, but just keep in mind they're not 100% accurate. You have to make certain estimates, certain adjustments. Now, what we have to be aware of is the cost of debt. The cost of debt is a little bit different than the cost of equity. Why? Because the cost of debt is influenced by taxes, and I will explain. Okay, so we need to emphasize the effect of taxes and the weighted average cost of debt. Because remember, the total value of the company is composed of equity and debt. But when it comes to debt, remember, debt is the interest on the debt. The debt generates interest. Interest on the debt is tax deductible. And we have to explain what does that mean for us. Okay? Recall that we always are concerned with the after-tax cash flow. If we are determining the discount rate appropriate to this cash flow, then the discount rate also needs to be expressed on after-tax basis. So we need to know what is the cost after-tax basis. As we discussed previously in various places, the interest paid by a corporation is deductible for tax purposes. So hopefully you know this. If not, I'm telling you right now, interest is tax deductible. However, remember also that payments to shareholders, such as dividend, are not tax deductible. What this means effectively is that the government pays for some of the interest. What does that mean? Well, if they give you a tax deduction, it means they're saving you on your taxes. It means you are saving money. It means the government is subsidizing part of your financing. That's if you do what? If you issue debt. So in determining an after-tax discount rate, we need to distinguish between the pre-tax and the after-tax cost of debt. So let's assume you're paying 8% on debt before tax. Then, as we said, the government is helping you with some of that debt. How are they helping you? They're giving you a tax deduction. So because they're giving you their tax deduction, your cost after tax should be less than 8%. Now we're going to find out how to do this. But the idea is, because they give you a tax deduction, they're giving you a break, basically. They're financing part of it. So let's take a look at an illustration. And it's very easy to calculate, but I want you to make sure you understand this. To illustrate, suppose a firm borrows $1 million at 9%. Okay? And the corporate tax rate is 34%. So let's do this. So the company borrowed $1 million and they're paying 9%. The tax rate is 34% for the sake of this example. Okay, so first let's calculate how much interest do we have to pay. Well, 9%, we have to pay $90,000 in interest expense, right? 1 million times 9%, you have to pay $90,000. Okay, all right. So what is that gonna do? Let's assume I'm gonna work some examples that your earning before interest and taxes. I'm just gonna make up a number. Earning before interest and taxes is let's do it in two separate scenarios. So EBIT. So your EBIT is 500,000. Your EBIT is 500,000. Now, earnings before interest and taxes, interest is 90,000. So you have to deduct the interest. So your earnings before taxes is 410,000. All right. Now your taxes, 34%. 34%. So if we take 410 times 0.34, you have to pay in taxes 139,400 minus 139,400. So your net income is 270,600. That's your net income. So the taxes that you paid are $139,400. Now, this is assuming you have interest. Now, what happened if you did not have this interest? What happened if you did not have this interest? So let's see what happened. No interest. So you have EBIT of 500,000. Interest is 0. It means you did not have this loan. You finance your company through that. Okay. Your interest, your earnings before taxes is 500,000. Now you have to pay 34% in taxes. So 500,000 times 0.34. You have to pay in taxes 170,000. Your net income is 500,000 minus 170 equal to 330,000. So notice, what is the net effect? Well, the net effect, if you really think about it, because you did not have the interest deduction, what happened is, if you take 170 minus 139,400, that's equal to, you paid more in taxes, 30,600. You paid more in taxes. Now you might be saying, hold on a second, I'm happy paying more in taxes because so give me 1 second, more in taxes. You might be saying, well, I'm okay, I'll pay more in taxes, but I have a higher net income. But what you are ignoring is, you have 0 interest, but you had to pay, if in case you did not borrow this $1 million, you had to bring it from somewhere else. If you issue stocks, you're going to have to pay, there's a cost of equity. If you issued stocks, there's a cost of common stock. So you have to pay maybe more of common stock. And remember, you have to pay more for common stock because there's more risk for common shareholders. So you might be paying cost of equity maybe 12%. But let's assume the cost of equity is 12%. So you brought this $1 million, not through that, through equity. And as a result, you had to pay 120,000. What's wrong with this? What's wrong with this is the cost of equity you cannot deduct. You cannot deduct. So really the cost of that, because you had to pay the cost of equity regardless, but the cost of that you paid and you got a deduction for it. You got a deduction. And as a result, you saved on your taxes 30,600. So this is the effect of debt. It gives you a tax break. It reduces your taxes. Okay? But remember, if you issue equity, you still have to make payment, but it doesn't get deducted. Okay? We're not showing the payment here. Let's assume the payment is 120. So you still have to pay the shareholders 120,000, reward them at 12%. Okay? So let's keep going here. So I showed you the detailed calculations. Hopefully now this number makes sense to you. So the total interest bill is $90,000, which in turn reduces your taxable income by 30,600, as I just showed you below. The after-tax interest bill. So what is your cost after tax? So what is your interest cost? Well, think about it. Let me show it to you here. You paid $90,000. So you paid $90,000 in interest. This is your interest. You have to pay it, but you have a tax saving. I'm going to put this in a different color of 30,600. That's a plus. That's a tax saving because you paid $90,000 in interest. The government gave you a tax deduction basically of 30,600. So what is your net cost? So if we take 90,000 minus 30,600 equal to 59,400, and that's your net interest cost, or your interest cost net of taxes. So basically what you end up doing, you end up paying 59,400 on a loan of $1 million. So really your rate is 5.94%. So your effective rate after taxes, because you get a tax deduction, 5.94%. So this is how the debt helps you. So the debt the debt is, it's going to give you a tax deduction. And as a result, although you paid $90,000 in taxes, you're going to save on your taxes. And I showed you this, hopefully, when I did both. And this is how you saved more when you have the interest. You saved on your taxes. But remember, if you don't have the debt, you're going to have equity. That's the assumption. Now, rather than going through all this calculation, there's a shortcut on how to calculate this after tax interest cost. So notice that in general, the after-tax interest is simply equal to the pre-tax multiplied by 1 minus the tax rate. So this is the formula on how to calculate the after-tax cost. So let's go ahead and apply it. If we use the symbol TFC to stand for corporate tax rate, then after-tax rate will be written as after-tax rate times 1 minus the tax rate. Okay, so if we use this example, if we'll take 9%, which is the interest cost, times 1 minus the tax rate, will give you automatically 5.94. So every time you have an interest expense, let's assume 10%, and your tax rate is 40%, you'll take 1 minus 0.4. Okay, so 10%, and your interest rate is, so your after-tax cost is 6%. So remember, your after-tax cost for that is a little bit lower than your pre-cost debt. And the higher your taxes are, the higher is the savings. So let me show you. If it's a 10%, if you're going to have to pay on interest 10%, and you're paying 50% in taxes, 1 minus 0.5, which is going to be 50% times 0.5, so your after-tax cost is only 5%. So companies with high tax rate, they would definitely rely on that, because that, it's going to give them a tax deduction, and as a result, they will save on your taxes. Okay? So bringing together the various topics we have discussed in this chapter, now we have the capital structure weight along the cost of equity and after-tax cost of debt. Remember, always, when you have the cost of debt, it has to be after tax. So to calculate the firm's overall cost of capital, we multiply the capital structure weight by the associated cost, then add them up. So here is the formula for the weighted average cost of capital. The value of equity, which is the percentage of equity, let's assume it's 60% equity, times the cost of equity. Let's assume the cost of equity is 12%. So that's going to give us the equity component. So the cost of equity here, 60, the weighted average cost, 0.6 times 0.12, so 0.072, that's the cost of equity. Now the debt, let's assume we have 40% debt, times, remember, the debt is the rate of the debt. The rate, I'm going to assume it is 8%, times 1 minus the tax rate. I'm going to assume the tax rate is 1 minus 0.34. Assume the tax rate is 34. So 1 minus 0.34 equal to 0.66 times 0.08, 0.052 times 0.4, 40%. That's going to give us 0.02112. So if we'll take this number plus 0.072, 0.072 will give us 0.0931. So our weighted average cost of capital is 9.31. So how do we interpret WACC? So what is this 9.311? Okay, so WACC has a straightforward interpretation. It's the overall return that the firm must earn on existing asset to maintain the value of the stock. So simply put, if you want to maintain the value of the company, you have to earn at least 9.31, because that's the weighted average cost of the capital for your company using debt and stock. So you have to earn at least 9.31. It also can be considered the required rate on any investment by the firm that have essentially the same risk as the existing operation. So if you're taking on a new project, and the new project has the same risk as the existing projects, then you would say, I'm going to use my required rate of return is 9.31 because this is my weighted average cost of capital. So because my risk is the same, it's safe to assume this is how much I should earn on this project. So if we're evaluating the cash flow from a proposed expansion of an existing operation, this is the discount rate that we would use. So we would use 9.31 as our discount rate. Now bear in mind that sometimes the company could have preferred stock in its capital structure. It doesn't make any difference. If we have also preferred stock, then our expression for the WACCs need a simple extension. So now we have three types of equity. We have common stock, This is for common stock. This is for the preferred stock. Okay, put it in a different color. So you will take, for example, here, let's assume we have 60% common stock and the rate is 10%, the cost of equity, the cost of common stock. We might have 10% coming from preferred stock and the cost of preferred stock is 4%. Then the remainder, obviously the remainder is what? The remainder is 30%. So the rest of the financing is 30% debt, and the cost of that is pre-tax is 8% times 1 minus 0.34. So it doesn't make a difference. Remember, the preferred stock has a simple calculation. So what we did is we added the preferred stock picture into this calculation. Okay, and let's work an example to see how this all fits together. So let's look at the BB Lean company. They always make small changes to the names of the companies. They have 1.4 million shares of common stock. The stock is currently selling for 20 million. Well, if we have 1.4 million shares times $20, that's going to give us the E. That's going to give us how much equity do we have in the company. So let's go ahead and do so. So we have 1.4 million times $20. That's going to be, the equity in the company is 28 million. The firm publicly debt traded was recently quoted at 93%. That's the price of the debt. It has a total face value of 5 million. So, and it's currently priced at 11%. The risk-free rate is 8%, and the market risk premium. So this is going to give us additional data. So what do we have to do now? We have to find the cost of the debt, because now we have E. What's the debt? The debt equal to, what's the price of the debt? The price of the debt is 0.93. It's given right here. The price of the debt is 0.93. And I have 5 million in debt. I multiply this by 5 million because this is how you find the value of the debt. So if you take 0.93 times 5 million, that's going to give me 4,650,000. Okay. So now what I have is I have the value of the debt and value of the equity. Now, so let's go ahead and find, so equity, we said equal to 28 million, debt equal to 4,650,000. Let's add them up. That's equal to 32,650,000. So what does equity represent? If we take 22, you don't have to do the whole thing, but I'm just gonna. Equity represent 85.75%, 76. So equity represent 85.76%. So that's the equity component. How did I find this? I took the equity divided by the total, and obviously the bond, the debt is the remainder, whatever the remainder is. If I make this minus 1, I can find the remainder. It's 14.2, 14.24%. Or to find the debt, I can take 4650 divided by the total, 32,650,000. I'll get 14.24. Okay, so the capital structure is 85.76 equity, 14.24 debt. Now I have to find out what's the cost of equity, and what's the cost of debt. Okay, because now I know the capital structure. Now what they're doing is this. They're not giving us the cost of equity. They want us to find it out. The risk-free rate is 8%. The market risk premium is 7%. This is coming from the prior session information. So now we need to calculate what's the cost of debt. You have estimated that Lean has a beta of 0.74 and the corporate tax rate is 0.3%. What's the WACC? Now first what we have to find out is we have to find out the cost of equity. Okay, what's the cost of equity? Because we're going to take the cost of equity multiplied by 85.76, and we have to find out the cost of debt. And remember, the